Temporarily, right now, cash, I think, is a good
because
investment.
rates are where they are.
Ray Dalio spoke at the 10th Milken Institute Asia Summit in Singapore on September 13th, where he advised that, at this moment, keeping your money in cash is a wise choice. And according to him, cash is currently a favorable option for your investments. Ray Dalio is the visionary investor who founded Bridgewater Associates, one of the world's leading asset management firms. His expertise doesn't lie solely in the present, but in his profound ability to decode generational economic patterns. Today, we'll embark on a journey to explore the insights of this financial personality. Ray Dalio will unveil 3 monumental economic shifts, the likes of which most people have never encountered in their lifetimes. These shifts are key to understanding where to invest your money for a prosperous future. So, join us as we dive into the world of economic transformation and unveil Dalio's game-changing investment insights. It was in 1975 when Ray Dalio established Bridgewater Associates, eventually transforming it into one of the world's largest asset management firms. Much of his success can be credited to his relentless focus on studying long-term economic trends. While many people tend to gauge future events based on their personal experiences and recent history, Dalio understands that some of the most pivotal global occurrences follow cycles spanning 50, 100, or even 200 years. Events such as world wars, pandemics, or shifts in the global order may transpire only once or not at all in a person's lifetime. This underscores the critical importance of delving into historical patterns to gain insights into the genesis of these events. There are 3 significant events occurring today that most people listening haven't witnessed in their lifetimes. First, there's a notable increase in government debt. You might wonder if governments have always had debt, and yes, they have. However, in the last 20 to 30 years, a marked change has occurred in how governments use debt in their overall policies. Instead of occasionally relying on debt when they need to spend more than what they collect in taxes, governments now consistently spend more than they earn in revenue. This means they borrow larger and larger sums of money each year with no plans to halt this practice. This issue has been growing for decades, but intensified significantly following the substantial debt incurred during the global financial crisis and the pandemic. Governments can keep borrowing more money for extended periods. However, there's a problem looming for the U.S. regarding the point at which interest payments on that debt become burdensome. What Dalio is conveying here is that a portion of the government's expenditures is allocated to servicing its massive $33 trillion debt. In simpler terms, this means that as the debt pile continues to grow, an increasingly larger chunk of tax revenue is utilized to cover the interest on this debt rather than being reinvested in the economy as it should be. The consequence of this is a slower growing economy with reduced productivity. This situation forces businesses to earn less income, potentially leading them to cut costs and downsize, further contributing to an economic slowdown. Another issue revolves around the bond market's supply and demand dynamics. Interest rates are influenced by the Federal Reserve's decisions regarding the federal funds rate, but it's crucial to recognize that the bond market operates like a free market, where prices are determined by the forces of supply and demand. If the U.S. government floods the bond market with an influx of new bonds due to their increasing borrowing, they need buyers to step in and purchase these bonds. If there's a lack of demand, interest rates will continue to rise. This situation poses a challenge, as the global financial landscape may not be prepared to handle higher interest rates. In fact, even a relatively modest increase, like the speculated 7% rates mentioned by Jamie Dimon, could potentially lead to significant adverse consequences. So, that's the predicament the U.S. finds itself in regarding its debt situation. It's the first of the 3 significant factors that haven't occurred within our lifetimes. The other 2 factors are internal political disputes and external global conflicts. The United States, as you've probably observed unless your attention has been elsewhere, has been experiencing intense political clashes in recent years. It's not your imagination. The 2 major political parties have significantly drifted apart in their ideologies over the past few decades. The left has moved farther to the left, while the right has shifted further rightward. This shift has fueled the rise of populism, with candidates like Bernie Sanders and Donald Trump campaigning against the political establishment. But before we continue, we want to thank you for watching this far. Additionally, there are external conflicts where other nations challenge the existing global order. This is the part where China poses a significant challenge to the United States. History has shown the consequences of such challenges to the world order. The current landscape is marked by 5 major factors, some of which are unprecedented in our lifetimes. However, we've never encountered all 5 simultaneously. The question arises, how should you invest in this uncertain environment? Ray Dalio strongly advocates for broad diversification in your investment portfolio, spanning various asset classes, currencies, and countries. When done thoughtfully, diversification can mitigate risks while still providing solid returns. Dalio emphasizes an often overlooked point: what you don't know can be more critical than what you do know. Despite decades of studying economics and financial markets, Dalio acknowledges that the complexity of financial markets means unexpected events can occur. Diversification is a practical way to protect your investments from unforeseen developments. For instance, diversifying across both currencies can be a prudent strategy if you're uncertain about the future value of the US dollar relative to another currency. Ray Dalio then went into the topic of selecting individual companies. He offered some insights for those interested in investing in artificial intelligence. In the context of significant technological shifts like AI, it's vital to categorize companies into 3 key groups. Firstly, there are companies that disregard entirely new technology, often falling behind or getting replaced by more innovative counterparts. Generally, investing in such companies may not be advisable as they tend to struggle in the competitive landscape of capitalism and may eventually go out of business. Secondly, the cutting-edge disruptors are the companies at the forefront of creating groundbreaking technologies. While some of these may emerge as massive success stories, distinguishing winners from the rest can be challenging. Comparing it to the late 90s, when Amazon was a modest online book retailer, identifying such disruptors can be akin to finding a needle in a haystack. Many of these companies might be overhyped and eventually lose value. Lastly, Dalio emphasized established companies that leverage new technology to enhance their competitive position. Examples of this approach include companies like Microsoft and Google, which possess deep competitive advantages and substantial resources to capitalize on emerging technologies. Dalio also expressed a preference for holding some cash at the moment. He argued that cash is an attractive option due to its relatively favorable returns compared to the era of 1% savings accounts. Depending on your location and prevailing interest rates, you can potentially earn 3.5% to 4% or even more on your cash holdings. While cash may not offer the long-term growth potential of stocks or real estate, Dalio suggested it can be a reasonable component of a diversified investment strategy. So, as Ray Dalio has pointed out, cash can play a vital role as a strategic element within a diversified investment portfolio. It's a point worth considering when devising your investment strategies for 2024 and beyond. This isn't about stashing all your money in cash, but recognizing that, given the current landscape, it can have its place alongside other assets. As you chart your financial path, consider how a mix of assets, including cash, can balance risk and opportunity. Cash provides flexibility, offering a cushion during market fluctuations or unforeseen events. It's a safe harbor in turbulent times. So, are you ready to assess your investment strategy? How will you incorporate cash into your diversified portfolio for the years ahead? Join the conversation in the comments below. And while you're at it, make sure to smash the like and subscribe buttons down below. Additionally, if you want to know more about how to safeguard your money during turbulent times, I highly recommend watching this amazing video. Simply click this video right here. Thank you for tuning in and stay tuned for more exciting content in the future.